Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market update. So in today's news, guys, we had some retail sales data come out of the US and showed that the consumer has spent a lot less in the January period than in the month of December. This was some indirect news pertaining to inflation. So we're going to take a look at that news headline and see how it impacted markets over the course of the day. We're also going to take a look at two earnings that I have prepared for you guys in the names of COINBASE and Trade Desk, who both reported earnings after the close here today. Tomorrow in the video, we're going to be covering Applied Materials, which also reported today. However, I only want to do two today. And the second company we're going to be covering is one that I haven't yet showcased on the channel, but that I do own a position in. It's going to be Evolution AB. Very seldomly talked about. One of my favorite companies in terms of growth for the next couple of years. Extremely profitable company. So we're going to be seeing what happened on their earnings that came out roughly 2 weeks ago. I absolutely have to present this one to you guys on the channel. And then obviously we're going to go over our technical analysis for our major indexes, our major tech names, and we will do my portfolio at the end of the video today because it's been a very juicy week and I want to keep you guys updated. So without further ado, guys, let's get right into today's video. SPY up 0.69%. QQQ taking a little bit of a breather here today as a lot of big tech names simply just consolidated, but we had very healthy rotation in the names of financials and healthcare, largely making up for that lack in QQQs. So on the one-day relative performance on the heat map, you can see here very healthy rotation in the bottom of the market. Big tech, though, taking advantage of this strength in the bottom half of the market to just simply consolidate a little bit. No real negative headlines across big tech. There was a simple headline yesterday that came out after the close that the New York mayor was suing some of your big tech companies in the names of Google, Meta, and Snapchat, namely, the lawsuit is going to, hinder the companies on a short-term basis, but it's nothing that they haven't faced before. So I think that they should be able to get through those fairly easily, but largely big tech pulling back on the day. One-day relative performance, everything pretty much in the green except for your communication services. I'll remind you, communication services mostly was led down by Google in that case. But as a whole, guys, everything looking very, very good to wrap up the week. A lot better than it was faring after Tuesday's CPI report, that's for sure. So what exactly happened on the news today to send the bulls in an absolute buying frenzy after the morning? Well, it was some retail sales data. Take a look at this. Retail sales fall 0.8% in January from December as shoppers pause after a strong holiday season. And look at this. They even went so far to include a picture from my favorite retailer ever, Costco, right? So retail sales fell 0.8% in January from the strong pace in December when they rose a revised 0.4%. So lower sales in January. Very, very good. Excluding sales at auto dealerships and gas stations, sales were down 0.5% for the month. The decline was bigger than the 0.10% drop that economists projected and marked the lowest monthly figure since March of last year. Economists attributed part of the pullback to weather conditions, but they also said the slowdown shows that shoppers may be finally buckling under higher interest rates and other financial hurdles, and that the economic momentum from the end of 2023 could be starting to fade. So this plays into inflation for the following reason, guys. Obviously, if people are more wary of their purchases, and this has been the case, guys, we've been now covering this for two earnings seasons in a row where companies have been reporting that consumers have lowered disposable income, right? So it's no surprise to us. It's just nice to see that the data is finally coming in line. The broader data is now in line with your earnings that have been reported from the companies. And it just goes to show, guys, that your goods inflation is largely going away. That CPI print that we had the other day, 66% of the reason for the increase in the CPI, which wasn't a bad number, it was still down from December, but 66% of the reason that we missed on Tuesday was services inflation, most notably because of housing. And we went over that in when we covered CPI on Tuesday. But just a quick reminder here, guys, in terms of your inflation, right, it's really not that bad anymore. So your red line right here, this is from your Bureau of Labor and Statistics website directly, right? So the CPI result that came out on Tuesday really wasn't that bad. This red line here is your 3.1 read that we got for January, lower than December, yes. This green line is your goods inflation. Now, does it look like inflation has gone away in most goods? Well, as you can see here, guys, we are now negative for the month of January. And this article for retail sales just came out today, right? So it just goes to show that consumers are spending far less amount of money on goods. Actually, that goods prices are now in deflationary territory, even though the regular inflation number is 3.1. It's largely boosted by services. Services still less energy services around 5.4%, and 66, as a matter of fact, percent of this number is shelter. But we said that shelter is a lagging indicator and should be coming down. So everything going in the right direction, guys. Inflation is finally going away. And why? Well, because as the article said, guys, the interest rates have now been so high for so long. Consumers are finally tapering back on their purchasing habits, and it's really causing goods inflation to come down, which is very, very good for your markets as a whole. Yes, it shows that the economy can potentially slow down, but we do have a fairly good buffer. We have full employment in the economy, and GDP has come in hotter than expected, so it can have a little bit of wiggle room to come down. So everything's good, guys. Inflation's coming down. The economy is still strong. The jobs market's still strong as well. Tomorrow, we have producer inflation, so that's going to give us an additional insight into the direction of inflation, this time from producers. I apologize. In yesterday's video, I misspoke. I said that producer inflation was going to be this morning on Thursday, but it's actually Friday morning. So tomorrow morning, going to get a little insight on that. So that's pretty much your wrap up as to why the bulls really went on a buying frenzy today. Just another indicator, guys, that inflation is coming down. And it opens the door for the Fed to reduce interest rates, not because the economy is bad, not because people are losing their jobs, but just to be more accommodative to the markets. And that's the best case scenario. So before we get into more technicals, guys, let us go over some earnings together. And we're going to be covering two. We're going to start off with Trade Desk. So Trade Desk in the after hours, almost up 20% to $90. But unfortunately, at these prices, guys, at $90, it's very tough for me to start a position in Trade Desk, even though I love the company. That's why I was buying the company down here in the $60 to $70 range. So a couple little points that I do want to go over, you guys. In terms of EPS, it was basically flat. So they didn't really miss, didn't really beat. Very flat on EPS. The revenue, however, beat by about 4% to the upside, about $600 million for the quarter. So that was very good. Now, a few things that I do like and a few cons about Trade Desk here, just before we get into the numbers, to give you guys some context for what we're looking at. So they're a pure form advertising play. They're basically a specialty is online ads, digital ads for companies. So pure form advertising play. And we all know that advertising has been on the uptick 2023 and 2024 as well. Why? Because we saw the earnings from Meta, Amazon, and Google, who all showcased that their advertising divisions were netly up and they guided up for 2024. So Trade Desk as well should be providing some very good numbers in 2024. Trade Desk also benefits from very low debt, guys. This company has almost no debt whatsoever. You can see here, the 2023 statement isn't here yet, but you know, pretty much they never had a lot of debt. And even in this year as well, their debt is pretty much under $300 million, well and above that over under the amount of free cash flow that they generate on a given year. Not here yet. They generated about $500 million of free cash flow in 2023. And their cash and cash equivalents now is sitting around $1.2 billion. So very, very good, low amount of debt for the company. So that's what you like to see as well. Their EPS is growing very healthily, 25% on average for the next 4 years. Their PEG ratio is actually a 2.6 at $90. So when it was significantly lower, we're talking before the earnings, right? 20%, it could have been justifiable to go and get a little bit more off of this. Their PEG ratio was closer to 2 at that point, but now at 2.6, the company is pretty expensive, guys, at $90. And I'll show you why. We're going to compare it with Meta at the end of the analysis. And I'll show you why Meta, even though Meta's at all-time highs, is actually a better deal than Trade Desk as a whole. The cons, the stock compensation, guys, too high. Yes, high stock compensation is a good thing because it just shows that management is tied into the performance of the company. So it can be a good thing. However, it can't be too much, as at least in Trade Desk, the stock compensation is outweighed by the amount of stock that they buy back on a given year. So number one, they're diluting the stock by giving management and executives compensation in terms of stock. But at the other hand, they're using their free cash flow to buy back shares, which kind of offsets the dilution of them issuing shares to management. Then they buy them back in the open market. So as long as your buybacks outweigh the stock comp, it's good. But the stock comp is so high, guys, this company could have far superior profit margins than the about roughly 9 to 10% that they make if only they started cutting back on their stock compensation. And lastly, once again, the valuation at $90, guys, the PEG ratio is a bit too high, and the free cash flow yield is pretty terrible, not gonna lie, only 1.37% when the stock is trading at $90. So that's a very, very low yield if you ask me. And how do you get the free cash flow yield, guys? Well, you just divide the amount of free cash flow by the market cap. It's very, very easy. And why do we look at free cash flow? It's very, very important, guys, very important metric. Free cash flow yield, it just when you buy one share of Trade Desk, how much of that share is just free cash flow for you, the investor? It's basically a buffer, a margin of safety, meaning that how much of a percentage of that share is actually just positive cash that the company generates. It really, in other words, the rest of the stock is basically a bunch of different multiples and speculation, but at least you have 1.37% of the stock that represents true free cash flow. It's kind of like a baseline. Usually you want to see free cash flow yields in the 3, 4, 5%. Anything above that is amazing, just means that you're getting a decent amount of free cash flow yield for your shares. But when we come down into the 2, 1%, guys, that's very, very low, even if the company is growing a lot. So let's take a look at the earnings here. So Trade Desk shares soar on revenue beat and strong guidance. Now, the Trade Desk said first quarter sales will be at least $478 million. So they guided up, right? Topping analyst expectations of $452 million there. That's very, very good. About a beat on expectation on guidance here for the next quarter by about 5%. Very, very decent. The company said its board has approved an additional $647 million in share repurchases, bringing the total amount of future buybacks to $700 million. Repurchases totaled $220 million in the fourth quarter. So they have about $700 million of shares outstanding that they can buy back. That's not, that's an okay amount, right? So it's 0.7, let's say 0.7 divided by your $37 billion. So that's about 1.82% of the outstanding float. Not the best, but not terrible either, right? 2% of outstanding float to be bought back. So that's fairly decent numbers as well. The Trade Desk specializes in providing technology to companies that want to target users across the web. As we said, they do online ads and has capitalized on the continuing shift in corporate ad budgets from traditional television to connected TVs and streaming platforms. This is very important. So their total addressable market over the next couple of years will be growing. But yes, they do have to compete with other large names such as Meta, Google, and Amazon. More and more of the world's leading advertisers are gravitating towards channels and partnerships that offer precision and premium value at scale, such as connected TVs and retail media. The connected TV market is expected to grow in 2024 alongside a broader recovery in the overall digital advertising market that's helped bolster Meta, Alphabet, and Amazon, which we've been talking about. So now let's get into some of the numbers here, guys. So Trade Desk by the numbers. Let's have a look. So if you can see here, guys, their gross spend. So how much do corporations spend on their platform? As you can see, compound annual growth rate is very, very good. Once again, in 2023, they grew the gross spend that people spend on their platform by 24%. Very good. How much revenue does this translate to them? Well, once again, they had almost about $2 billion worth of revenue in 2023. Net increase 23% year over year from 2022. So very good. You can see this company, although it is still growing, it's coming into a more mature growth phase, not growing at 55 or even high 30% per year, really only about 20%. And that's going to be the forecast, guys, for the next couple of years as well, right around that 20% number. So very healthy. You're right. They're growing EPS over 20%, growing revenue over 20%. That's good. But the valuation, the stock price right now is just a little too high despite all of that growth. And what I did want to show you guys, I'm not going to go through their slides in presenting the company. If you guys want to learn more about Trade Desk, you guys can pretty much do that on your own time. What we're going to do here, however, is go over a few of the company's financials if I can find them. So once again, robust revenue growth, quarter over quarter revenue growth, and year over year revenue growth. That's exactly what we saw. Now you also see that they are growing profitability on a quarter over quarter basis. So very nice net income growth from quarter to quarter, really starting to accelerate that profitability. But as I said, if they get rid of that shareholder compensation, they will be in a much better position as a whole. So we're going to take a look at just a few of their metrics, guys, and then we're going to go on to the next one because I do want to do the portfolio on the day here. So you can see here, revenue netly up, right? But the problem that I have with this company is some of their expenses are just too high. They're growing too high. So take a look at the revenue. I'm sorry, I cannot annotate this document. For some reason, it's not cooperating with my annotation software, but we're going to do this together right here. So 1946 divided by your 1577, that's revenue growth of about 23%. That's what the graph above showed us, right? So keep in mind 23% for your revenue growth. but take a look at your expenses. 1745 divided by 1464, that's an expense expansion by about 19%. And in some categories, it's just too much, guys. Yes, your G&A, so general and administrative expenses, declined year over year. So that's good. But take a look. Technology and development, I'll give it to them because they have to develop their platform, obviously, but still 28% year over year growth in that division of expenses. Sales and marketing. Now, yes, they are an advertising company. They do, so basically they also pay for sales and marketing to market their products to different people, right? But still, that sales and marketing expense up 32%. That's above those two categories, netly above our revenue growth, right? And here's our platform operations. So how much does it cost them to actually operate their trade desk software for companies? And that also, so that is more directly related to your operating expenses, right? So that 365 divided by 281, that is still above your revenue growth rate. So a few of these categories, guys, actually 3 out of 4 of their major expense categories have been growing higher than the revenue. This is a problem if it's not addressed. I need to see more cost management by the company. They've been focused a lot on growth, but now it's time, especially considering the most recent share price after hours, it's time to start cutting down on some costs, or they may end up with some negative surprises. You cannot all be focused on the growth of the addressable market and the growth of your revenue. You have to do that while maintaining positive operating leverage. This is what I've been harping about pretty much on every single earnings report that we go through. Is the revenue growing faster than expenses? That's positive operating leverage. And here we can see, unfortunately, Trade Desk not having positive operating leverage. For the most part, expenses growing faster than your revenue. So that is a problem, right? It would just mean that their net income would be significantly better. If they can get these costs under control, they could be generating, 20, 25% margins, similar to what Amazon, Facebook, and Google generate on their ad divisions. It's very, very simple. There's no reason for this company not to be making as much money in the bottom line as those other companies do. And now what I also wanted to show you here, guys, is your stock-based compensation. This is too much. It's way, way, way too much. You can see it came down here from 2022 all the way to 2023. So 498 million down to 491, but it's just too much as a percentage of overall revenue, guys. Take in consideration 491, right? $491 million, and they only made about $2 billion. It's way too much, right? 491 divided by your 1946, about 25% of revenue. That's absolutely ridiculous. And when you go through this statement, they say that it's to compensate management and to have management be more oriented towards the business. So they're tying in the management compensation with performance of the business. However, there needs to be a middle point, guys. I understand that, and that's a well-known thing in the finance world, right? Where you try to tie in your executives' performance with the performance of the business. But this is way, way, way too much, guys. In my opinion, this number needs to be at least halved for it to make sense. So those are a few of the negative things that I didn't like about Trade Desk. I love the company as a whole, but at $90 for me, this is when I consider potentially taking some money out of the stock, taking some profits at this point. And there's some very nice plays, guys. Just take a look at Meta, right? So take a look at these ratios. Right, PEG ratio at about 2.6, their free cash flow yield 1.37, which is extremely low. Now let's take a look at Meta in comparison. So Meta, you might think, wow, it's at all-time highs. The stock must be expensive. Well, actually, not so much. So their 2024 EPS is $19.90. I'll do the math with you guys together so you guys can do it at home in the future. So their 2024 EPS going forward is about $19.90. So the stock price right now is 44 divided by $19.90. That gives them a PE ratio 2024 ending of about 24. They're growing EPS at a 15% rate per year. So we divide the PE ratio by the growth rate to get their PEG. So we can compare two companies that do similar things. We can compare them on a common denominator. Very important. All right. So we divide that by 15. You can see their PEG is only about a 1.62. That is significantly better than Trade Desk. I'll remind you, anything between 1.2 is between 1 and 2 is decent. Under 1 is amazing, but a lot of companies, it's tough to find them under 1. Between 1 and 2 is fairly decent, and their free cash flow yield is a lot better. So Meta, last year, bought about $44 billion in free cash flow to the bottom line, and their market cap is about 1.2 trillion. Let's call it about, it's right down here, 1.23 trillion. So let's call it 1230. So you'll see that the free cash flow yield on Meta is about 3.5%. And if you don't believe me, well, you can just do Meta free cash flow yield on Google, and it should give it to you. Here you go. You can see it's right here on Finbox, about 3.7%. So although we were off by a little bit, it just gives you a really good representation when you do it like this, right? So Meta, cheaper PEG ratio, better cash flow, free cash flow yield, right? And still the company is at all-time highs. Trade Desk off the all-time highs, but it paints a different picture. It's at $90, and you can see these fundamentals are worse than Meta. So stock price as a percentage of all-time high can be a little bit tricky if you only look at that. You need to understand the context of this. So hopefully I've provided a little bit of context on Trade Desk. Once again, love the company, but their expenses need to be brought under control, and their stock-based compensation as a result of those expenses as well need to be brought under control. I would need to see them put in, a disclaimer or potentially a condition on those stock-based compensations. If they can't bring down expenses, then the stock-based compensation should not be increased at all. So that is pretty much everything that I had to say about Trade Desk. Now, stock number 2 is going to be Coinbase. So Coinbase, decent recovery story, right? Basically off of crypto. A lot of people get into Coinbase just trying to, as a proxy for trading crypto. Now, in my humble opinion, I don't do that. If I'm trading Coinbase, I'm trading Coinbase because of the fundamentals of this company. If you want to have a proxy for crypto, well, then there's a lot better plays than that in terms of how they follow and how they mirror Bitcoin. You can obviously trade crypto directly, but another few stocks, right? Mara, the Bitcoin, the crypto miners are going to be better proxies for crypto directly. Coinbase, yes, it follows crypto. However, not my favorite play just for having some crypto exposure as a whole. So here are some things that the company has been doing well. So Coinbase came out with earnings today. Decent beat on EPS, guys. They were actually expected to be negative on the quarter or slightly positive. They came out with a huge beat, almost $1 in EPS. Very good. And they beat on revenue as well, 15% to the upside. This company was expected not to be profitable in Q4, which is why they're up so much in the after hours here today. You can see after their earnings, pretty much up about 14% at this point after hours. So yes, Coinbase is currently up, but I have some few problems with the company as well, which doesn't make it one of my favorite plays. Now, the company does have a low amount of debt, so I'll show you guys that right away. So just so you can see, low amount of debt. So even though they're growing, even though they've had their problems, they do have a fairly low amount of debt, right? So they're only coming in to this year pretty much with about $3.25 billion worth of debt, and cash equivalents is sitting currently at about $6 billion. So largely enough money to pay down that debt. Cost management. They've been very good at managing their costs. Now, Coinbase has had problems with consistent profitability. You can see here negative net margins. So over the course of the past year, they've been doing a good job at getting their cost management in control, and it's paid off. They have remained profitable over this last quarter at least. And that's what I've been saying, return to profitability and return of the transaction volume. A big problem with this company was the same problem affecting crypto. There was just not enough transaction volume in relation to years like 2020 and 2021, but that has been on the rise. Now, the cons. Number one, cannibalization. This is very, very simple. When the Bitcoin ETFs came out, there was a lot of speculation. Because now there's a lot of public ETFs to trade Bitcoin on the markets, would people stop trading Bitcoin in Coinbase and stop opening Coinbase accounts and just trade crypto through their regular brokers like Interactive Brokers, TD, or Schwab, stuff like that? Would they just buy it in there through the form of the ETFs? So there's a big speculation on whether or not that would materialize. So far, we don't have enough data to actually view if that has materialized or not. But as a whole, their volumes over the past quarter have been increasing. So seemingly not being affected by those Bitcoin ETFs just yet, potentially. Now, the cons as well. Can they be profitable for an entire fiscal year? Coinbase has not been profitable since 2021 on an annualized basis. This has been their first quarter in 2 years that they've made a profit. So will they be able to keep this into 2024? That is a sticking point. The valuation as well, fairly rich, guys, right? So they're valued, since they don't have positive EPS. Excuse me. Since they don't have a positive EPS, guys, we have to value them on a price to sales ratio. And unfortunately, their price to sales is fairly high. This could be lower. I understand it's a growth company, but the valuation, guys, is just a little bit rich in my opinion for that. If you want to compare price to sales is very easy, guys. If you want to take a company like Google, just take Google. How much sales did they do in the past year? You can see Google has revenue of about 310 billion. And you just divide the amount of of revenue that's generated on a given year by their market cap. So in this case, it would be 1780. So you can see price to sales on Google is roughly, sorry, I did that the wrong way around. So 1.78 divided by your 310 is going to roughly be about 5-6 price to sales. So even a company like Google, right, is on a relative basis 2 times cheaper than Coinbase if you use that valuation method. Number 4 here are going to be inconsistent revenue and EPS growth. The company is just not predictable, guys, which is why it's so hard to develop price targets for this company. If you take a look, I want to see predictable EPS growth. Now, is this predictable? Positive 2021, terrible 2022, flat 2023, almost unprofitable. 24, 25, 26, 27, still supposedly not going to be bringing money to the bottom line. So just not consistent. And even on the revenue, guys, revenue is not any better. Look at this inconsistency in revenue, right? You want to see a beautiful, slowly uptrending chart, something like Google, but most of big tech has this as well, right? Or a lot of other normal companies have this as well. Coinbase, just not very predictable at all. And number 5, once again, high stock compensation. This is a problem for the company. Once again, them as well as Trade Desk, they justify it. Well, they want to tie management's performance into the stock's performance, into the company's performance. Well, I mean, if the company's not yet profitable, I don't see a reason why you should be giving so much stock compensation. And Trade Desk, the company could be more profitable if they didn't do enough, if they didn't do as much stock-based compensation. So these 2 past companies, guys, stock-based compensation, this is why I look at it so much. It's because it's a problem. They're favoring giving shares to management and executives, even though the company is not performing up to standard, whereas they could be using that money to give better net margins and higher return on EPS to you, the shareholder. So that's why it matters. Now, let's take a look at some of the headlines. Coinbase shares climb after unexpected return to profitability. And it was not expected. They posted a profit for the first time in 2 years at the 4th quarter rebound in digital asset markets lifted trading revenue. So obviously, Bitcoin has been on an absolute tear as of recently, and all of crypto has pretty much over the 4th quarter since October, November, December, and now we're into January and February. So that's why they had an increase in volume right there. Coinbase was widely perceived to be an unprofitable company, and this quarter can start changing the image going forward. I think the next step is to see if Coinbase can maintain profitability for the full year. There you go. Wall Street has been watching Coinbase for signs that the array of newly launched US ETFs investing directly into Bitcoin may cannibalize some of Coinbase's retail revenue. So that's what we were talking about, right? The exchange makes more money off retail users than from institutions. We'll see that breakdown in a bit. In the letter, Coinbase cited excitement around Bitcoin spot ETF approvals and broad expectations around improving macro conditions in 2024 as reasons for the sharp increase in crypto volatility in the 4th quarter. Basically, they're saying that their clients are more bullish on crypto for 2024. Investors are also watching the impact the ETFs on Coinbase's custodial fee revenue, which increased $20 million in the 4th quarter. Coinbase serves as a custodian for 8 of the 10 spot Bitcoin ETFs, and as these funds gain funds, should benefit from the growth in these fees. If you guys don't know what a custodian is, it's very easy. These ETFs need to buy Bitcoin from somewhere, and obviously they're not going to open wallets themselves and do that. That would be fairly dangerous for them. So what they do is they're partnered with Coinbase pretty much to be like, okay, we're the ETF. We need to buy some Bitcoin. Where can we hold that Bitcoin safely? And Coinbase serves as their custodian. Basically, they take the Bitcoin from the ETFs and hold it in custody, safekeeping for those ETFs. And in return, they obviously charge a fee for that service. So we're going to take a look at exactly how that fee breakdown happens on the structure. Let's take a little bit of a look into their financial statements, and then we'll get right into our technical analysis. So in 2023, we saw our operational rigor pay off. We achieved our financial goal, launched new innovative products, strengthened our competitive position, and doubled down on our efforts to create momentum for a workable regulatory framework for crypto in the US. This has to be said about Coinbase, guys. They have done more than any other company in the world for legalizing crypto to be offered on trading platforms. So you have to give them that. And they have been doing some fairly efficient cost control as well. So have to give them those 2 points in terms of that. But some of the bullishness for me ends right there. So here's your full year. You can see 2023, they brought in almost $3 billion in net revenue. Well, here's 2022. You can see they're actually down on a year-over-year comparison. So a little bit of a drop off in year-over-year comparisons here, but potentially with the rekindling of Bitcoin and crypto trading as a whole, 2024 probably going to be a better year for them than 2023. So this should be up on a 2024 rolling basis. Now, 2023 was characterized by financial discipline and operational excellence for Coinbase, reiterating once again their cost control. Now, let's take a look at their total revenue breakdown, guys. So they make revenue through transactions, but they also make revenue through subscription and services revenue, which is broken down on the following segments here. So let me move myself over. We're going to do a little bit of a deep dive into these numbers here. So you'll see that consumer revenue as a whole netly down, guys. Total transaction revenue as a whole, as a matter of fact, 36% decline in transaction revenue from 2022 to 2023. So that was pretty much saying the crypto market was soft. Not a lot of people trading it, but their subscription and services revenue, huge increase, 77% increase. So what they lost here, they largely pretty much regained here. And that's what you want to see, guys. The business is fairly diversified, and now they'll be able to increase subscription and services revenue in 2024 and recapture some of this transaction revenue as well. So should be a fairly good year for them as a whole. Now, we see the reiteration of that. 2023 transaction revenue was down 36% year over year. Total trading volume was 468 billion. Seems like a lot, right? But down 44% year over year. Consumer trading volume was down, was 75 billion, down 55% year over year, and institutional volume was 393 billion. So here's something that I want you guys to notice. Can you see here? Consumer trading volume is $75 billion. Institutional trading volume is almost $400 billion. So 5 times more. But look who pays the most fees. So you saw that consumers represent only 1/5 of total trading volume, right? So here you can see they bring in a lot of transaction revenue from their consumers, but the institutions who literally have 80% of all trading volume, do they make much money from the institutions? Not at all, right? So giving some institutions better pricing than your consumers. This, in my opinion, guys, yes, it's to attract institutions to their base, but they could monetize this a little bit better. This discrepancy is absolutely ridiculous. For you to be 80% of total trading volume, right? 80% are the institutions, and for your amount of transaction revenue to only be 5-6% of total transaction revenue, that's not too good. They need to do a little bit better of a job of monetizing this. So here you go, trading volume. That's where you see the net drop here in trading volume, and institutional trading volume has dropped down as well on a year-over-year basis. Net revenue as a percentage of total, that's just breaking down how much of this is total subscriptions, the purple boxes versus total transactions. So as you can see, subscriptions have been taking more and more place. That's just because of transaction volume coming largely down, but I do expect subscriptions and services to increase. So hopefully we'll get a little bit of a take back by transactions here, but services should be pretty good as well. And now, guys, you can see the operating expenses. They've been doing a good job here over 2023 of really reducing those operating expenses, trying to maintain their profitability here. So what I did want to do here, guys, is lastly take a little bit of a look at the reason why I say that their shareholders, sorry guys, I wish I could remember which page this is on. I think it's on 23. Yeah, it actually is, as a matter of fact. So here is a couple items that I wanted to bring to your expenses, right? So look at this drop in revenue, right? Drop in revenue. There's your drop in revenue. But take a look at this heavy drop in operating expenses, right? Almost $2.5 billion in operating expenses were cut. So really help them, guys, turn the corner, stay a lean basis. But the last thing we're going to cover, guys, stockholder compensation. So as you can see here, shareholder compensation, they brought it down. It was 1.5 billion in 2022, but still about $780 million worth of stock-based compensation. If you take stock-based compensation, guys, as a portion of their total revenue, so let's take 780 divided by 2926. Once again, 26%, same thing as Trade Desk, right? It's just too much money for a company that's not generating the amount of net profits that it should be generating. So that's why it's too high in my opinion. So that's pretty much everything that I had for you guys for Coinbase. Hopefully I was able to showcase why those two companies are good and also why those two companies have their own drawbacks. As I said, Coinbase, not my favorite pick. I don't play Coinbase. I don't own long-term Coinbase shares personally. Sometimes I do make plays on them in terms of selling short puts, but not a company that I would own in my long-term portfolio. Nonetheless, I would just prefer to own crypto outright. So now let's get into the technical analysis. And not much has changed, guys. So we're going to go over this quickly so we can get to the portfolio. So SPY, continuous motion of the daily uptrend, right? We were saying here CPI, potentially looking out for the daily downtrend formation, but now the bulls have overtaken most of the move at this point. Hourly trend was your guide at that point. I said, if we lose the hourly trend into today, keep an eye on that. Could be setting up for a daily higher, lower high into lower low continuation down. But now the bulls have pretty much almost fully engulfed your CPI move. Daily RSI is not overbought anymore. And the weekly still remains overbought, but the bulls still with a little bit of room to move, guys. If you can't consolidate here, if you can't even get a 4-hour downtrend, guys, the bears are just going to continue getting steamrolled by the bulls here. They need to be able to follow through. So far, no follow through. So now at this point, guys, we're just looking as soon as this move tops out here, meaning as soon as you lose this hourly trend to the downside, we're going to be looking out for a daily higher low. Need to protect this low right here. 491.17 is your new higher low. So if we do, for some reason tomorrow, let's say PPI is a disaster, I'd be very surprised. But if it is a disaster, we start rolling over into the next few weeks. Keep in mind, we also have our February seasonality that temporarily dips off over the course of the next couple of weeks. So we'll keep a very close eye on that. But as of now, bulls in full control of these markets right now. Daily uptrend confirmed, and your weekly uptrend simply continues at this point. Leg number 3, right? 1, 2, 3 beautiful legs higher, creating a ton of space from your previous all-time highs. Now moving on to QQQ. Same principle for QQQ, but the QQQ bounce is a little bit weaker. You can see SPY almost back to your previous highs from before CPI. QQQ, not so much. That's just because big tech had a little bit of a sell-off here today, but still looking bullish, right? They still have control of your short-term time frame. So we'll see, can they maintain the hourly uptrend in tomorrow? In that case, guys, we're just going to continue this daily uptrend to the upside. But if for whatever which reason we lose it into tomorrow, right, then we're going to be looking out, well, we potentially peaked out on the 4-hour time frame into 4-hour downtrend at that point, and then we'll be looking out, can the bulls protect 425.11 for your daily higher low, right? And if they break that, obviously daily downtrend, and then we will be looking for weekly consolidation. But as a whole, bulls have now created enough space off the lows to be able to even two-step this process, right? And this level right here, 429-ish, is going to be a big one. Previous resistance should now be acting as a bit of support. 12 EMA right there as well. So keep an eye on those levels here, guys. Bulls in full short-term control currently. Even the short trade that I was looking out for, guys, hasn't manifested, right? We were looking for a loss of the hourly trend change on this daily bounce to signal a daily lower high into a potential daily lower low rollover. But if they're not rolling over the hourly trend, guys, I can't enter this short trade. That's the condition. Now moving on to financials. Financials, this is why the bulls are in absolute full control. Even though SPY hasn't pushed above, look, we do have a few indexes that have. Financials and healthcare were the clues today to know if we are going to continue and if QQQ might continue as well. I do think so, guys. XLF break and close above at this point. So we're monitoring this tightening range. We never lost the lows right here, even on the CPI day. We were saying because our long-term bulls are in control of your financial sector, wouldn't be surprised if this tightening range at the top end of a move, protecting your 12 EMA all the time, using it as defense, right? Wouldn't be surprised if this breaks bullish. And as a result, it most recently just broke bullish today. So looking very healthy on financials, new high at this point. Daily uptrend back in motion. Any pullback, just looking for a daily higher low for further trend continuation. Keep an eye on this new level, guys. 39.25 should be a very juicy area. This whole area that we just got through, right, is going to provide a very decent level if ever we choose to have a slight little dip. I do believe it's going to be a breakout of this zone, retest this zone just for further upside momentum. And as I showed you guys, weekly bulls are in absolute full control at this point. Overhead targets of resistance, guys, we are almost there. We're talking about $40.50. That's going to be really the top end of your all-time high range. So just keep an eye on that level. It starts pretty soon at around the $40 mark. You can see this little range, the top end of this range right here. So we're coming up into that top end of the range. So where would we be peaking? In my opinion, 40 to 40.5 is going to be potentially the top of this weekly leg up. before a bit of consolidation and maybe look to move even higher over the rest of the year. Now moving on to healthcare. Healthcare also looking very, very decent on the daily. Daily trend was absolutely gorgeous. We were always looking for a daily higher low for further trend continuation. I was saying keep an eye on this red line and this bar right here. This yellow bar right here is your previous most recent resistance, now acting as support. The red line is your previous area of all-time highs. So we have now mounted the all-time highs, broken out of them, retested them, and now on to a future leg. So daily uptrend is extremely healthy at this point. Any pullback just looking for a daily higher low above 142.10. If for ever which reason the rest of the market continues to pushing upside, right, I would not be surprised if this is going to hit the potential $150 of psychological resistance. Obviously, we're beyond the all-time highs, so no resistance, have to go with psychological numbers, and that should be 150. Healthcare looking very, very gorgeous, and even on the weekly, guys, weekly uptrend beautifully in motion at this point, and monthly uptrend as well, just pushing beyond your all-time highs. So much space above the all-time highs at this point that any extended consolidation, even if we do consolidate for our February and March even seasonality here, I would be highly surprised if the bears manage to get it, much below our all-time highs here. Should just be a breakout and potential retest maybe for the month of March before further rallies into 2024. Healthcare looking good. IWM Russell outperformance story on the day, 2.67% to the upside. Take a look at the Russell, guys, after the 4.5% CPI drop. Now, after 2 days, setting the daily uptrend. Absolute disaster for any bears that were in this trade. Really painful trade for them, right? Blasting off to pretty much almost new 52-week highs at this point. So now daily uptrend has been recaptured. So short-term bulls are back in control. That is absolutely huge, guys. Any pullback at this point, going to be looking for a daily higher low, anything above 193.12, daily higher low for potential further trend continuation. What I want to see is give me a weekly close above this range. As you can see, we have not closed a weekly candle in a substantial fashion over this big 1.5-year range, in the past 1.5 years at this point, right? So that is what we need to see. At this point, we are looking for the potential weekly trend breakout resumption and potential monthly uptrend formation as well for the Russell. So very curious to see if they can close this in here tomorrow. We'll be looking very good. We get a little bit of momentum continuation into next week as well. Could give us enough space that if end of February and March are a little bit bad for the markets, could just be breaking out and then retesting this area slowly as support. If we do that and then retest, I will be buying some shares in this location right here. But as of now, still a little bit, uncertain whether or not we'll be able to really close and break above this area. But so far, so good, looking good. Bulls, short-term control of your daily timeframes. Bulls, also short-term control of your weekly timeframes, right? Weekly uptrend now on the verge of being confirmed. And also the monthly breakout, guys, is looking good. This is pretty much a monthly cup and handle, right? Breakout, very, very solid pattern for the bulls. Now moving on to the Dow Jones. Dow Jones recovering beautifully. Once again, now back above our 12 EMA. So Dow Jones, I was highlighting this, right? We've only lost the 12 EMA in the past 4 months at this point, guys, right? Twice, once here, once there, and both times within the following 2 trading days, we're now back above it. So that's why it acts as a perfect guide for the Dow Jones, in my opinion. Bulls at this point, just looking to recapture that daily uptrend. That will need a break of the all-time high, 38,925, towards the upside here. Then we'll create enough space to just maintain this daily uptrend until the bears really prove it to us that they can maintain below this 12 EMA. We are not yet going into weekly consolidation for the Dow Jones. Dow Jones still looking good. Weekly uptrend just blasting off at this point, and monthly uptrend healthily in motion too. And now there's so much space above this previous all-time high, guys, that even if we do consolidate for a little bit, we may at best just graze the lower end of this 37,500-ish area. But it's going to be highly unlikely that we have a very nasty pullback that really takes us down below our all-time highs right here. I do expect our previous all-time highs to act as great support. Personally, can't really buy the Dow Jones up here, but if I did have a bias for any trades, I would be looking for a first daily downtrend here since the month of October to really start building some longer-term swing trade positions if we do dip down. Now, let's move on to our major tech names, and then we're going to do my portfolio. So, big tech. Apple looking good into the end of the day. So they had a nice little dip early on in the day here, 181.53, but largely recovering intraday. So you really love to see that. Apple still stuck here, guys, right? So we're still trying to eventually reverse this into a daily uptrend. The bulls have not had a daily uptrend since all the way back here early January. And then we lost it, and now we're pretty much in a tightening range formation. So now the bears have taken back a lot of this move. So what you want to see, guys, is protect this area right here, 180. As I was saying in yesterday's video, 180 is crucial. Lose 180, you set the daily downtrend, but not only that, you would also set a weekly downtrend in Apple as well. Is that such of a big deal? No, because it just means that we might be in for extended monthly consolidation on Apple. Keep in mind, the revenues aren't growing that much for 2024. Right? And Apple sometimes, when it has had an increase in valuation and then has a bit of a flat year in terms of revenue, may just consolidate a little bit, guys, at the top end of the move, right? So very, very healthy monthly consolidation is still underway. I keep reiterating, if we dip down 175 all the way down to 165 pretty much, I will be buying Apple, no questions asked. Very solid company, nothing wrong with the company. Just short-term price action is a bit skewed. This whole area 190 to about 187 is going to be acting as overhead resistance. So in my opinion, guys, we're probably just going to continue to tighten up here unless the market's really going to tear. Apple can then regain its daily uptrend. But for now, right, the daily bears are in control, looking to protect these lows right here. Just going to be looking for Apple to bottom out in its process and really tighten up this range as much as possible. Usually these accumulation phases do tend to break bullish for Apple. So the tighter we get, in my opinion, the better. Just a healthy accumulation phase for the company. Now moving on to AMD. AMD down a little bit on the day after their significant rally yesterday. So AMD desperately trying to break out of this tightening range pattern, right? So we do have a new daily uptrend right now. Any pullback just going to be for a daily higher low, anything above 164, daily higher low to try to set a furtherance of the daily uptrend at this point. Keep an eye on your 12 EMA. The bulls like playing defense around this 12 EMA. So if we do come down 173 first stop, absolutely need to protect this 164. If you lose 164 to the downside, you lose the daily uptrend, and then you really have to rely on your weekly time frame bulls to protect this previous all-time high area, 164 up to about 158. Tough for me to buy the company up here personally. Has had some significant weekly consolidation in the past 3-4 weeks at this point. So it's been good for slightly cooling off your RSI, but RSI is still overbought. Daily is no longer overbought though, but still trapped in this consolidation range here, guys. NVIDIA has earnings next Wednesday. I would be surprised if AMD has much of a move before NVIDIA comes out with their earnings, because this stock highly moves because of their new line of business, which is the line of business NVIDIA has been growing, their cloud computing division, right? So need to keep a close eye on AMD, but so far looking good. Daily uptrend recaptured. Weekly uptrend was never lost, just healthy weekly consolidation for a potential move higher here. So AMD looking fairly balanced. Now moving on to Amazon. Amazon down 0.69%. Amazon still just doing its little thing here after earnings. So really consolidating at the top end of their earnings move. You really see this best on the weekly chart. So beautiful weekly uptrend, right? Just sideways weekly consolidation for now. Even any further consolidation, guys, anything above 144.50-ish, just going to be looking for a weekly higher low for further trend continuation. And then we're really eyeing the previous all-time high range, right? 177 is your first stop, and then all the way to the all-time high peaks, 187. But this 177 should be somewhat of a little bit of a difficult area for Amazon to get through. So if they just consolidate sideways here, not too big of a deal. Even if you do lose, right now, it's a beautiful daily uptrend right now. They lost it. They're trying to come back. Even if you set the higher lower high and roll over to lower low conditions to try and fill this earnings gap, not too big of a deal. Why? They have so much space on the weekly, guys. So much space to come down, maybe even into this 12 EMA, which is about 160-ish, right? Come down, pull back, and make another stab at those all-time highs. Amazon looking very good. Now moving on to Google. Google as well, consolidating, was a beautiful little dip buying opportunity on the day today. And Google, same principle pretty much. Google is just trying to protect some of its previous weekly levels. So daily uptrend was lost. Then we were looking for the size of the bounce. The size of the bounce that the bulls had after this move down was about 70%. That sets your bulls up for a good chance at setting a daily higher low for higher high conversion to a daily uptrend. And now you can see the bears have pulled back a lot into this move, right? But we're coming up on a juicy area of support. In my opinion, 140 down to about 138. Previous resistance in the past should be acting as support, and I'm heavily playing Google in this area right here. Beautiful weekly uptrend, has been consolidating for the past 3 weeks after earnings. Very healthy consolidation in my opinion, and the monthly uptrend also showcases a beautifully healthy monthly uptrend, just struggling with our previous all-time highs in the 150s. But Google looking fairly good here, guys. If we just continue to, for some reason, tighten up above our weekly area of support, that would also be a very good case scenario, guys, to be, being able to trade the stock, build positions in anticipation of its next move up. I don't believe Google is in any jeopardy of losing these major levels and really reversing to the downside. So for me, I'll just be in an accumulation phase as long as we stay close to the 140 mark. That is where I love making plays on Google myself. But everything looking very healthy here, guys. Just right now in a bit of a tightening range. Obviously, if you break this 150.57, daily uptrend is confirmed. Your weekly higher lows are set, and then we'll be looking for a weekly leg higher towards the all-time highs. Moving on to Meta. Meta looking fairly good as well. 2.27% to the upside. Just barely put in a new all-time high. So hopefully that valuation on Meta was helpful for you guys earlier. It's not that expensive, guys. When you look at this stock, even though it's trading at all-time highs, not that expensive at all. Now, daily uptrend is obviously confirmed. After a little bit of consolidation, now we finally have a breakout. So this is just continuance of the daily uptrend at this point after some consolidation. So if ever we pull back, anything above 455.23, just looking for a daily higher low for further trend continuation. And the weekly is obviously very gorgeous as well. Beautiful weekly uptrend, little bit of consolidation here the past 2 weeks, just setting the weekly higher low into weekly higher high conversion for the bulls. So looking very, very good on Meta. Nothing bad to say at all. The next area of resistance, guys, has to be your $500 psychological number. Beyond the all-time highs, no previous points of reference. So Meta looking very good. Now moving on to Microsoft. Microsoft as well, not looking too bad at all, 0.72%, consolidating sideways for the past couple of days, right? So Microsoft, beautiful uptrend, and then they had a consolidation range at the top end of this entire move, consolidation range, breakout, daily uptrend, and now we're struggling with the previous daily higher low, which is 403.18. So analysis, same as yesterday on Microsoft. If for ever which reason we lose the daily uptrend and set a daily downtrend, no problem at all, guys. Weekly higher lows will be set. 367, anything above 367, just looking for a weekly higher low for further trend continuation. If I get down to 393.80, I will be playing some short put options on Microsoft. So not too far away, but nice to see Microsoft just cool off this daily RSI, cool off the weekly RSI ever so slightly a little bit. Now it's just consolidating sideways. So really nothing bad about the company whatsoever, right? If we do lose 403.31, daily downtrend is in motion. Weekly consolidation just continues. And then we'll be looking for the bulls to play defense around that 391 area. So looking very good on Microsoft. Nothing bad to say about the company. And obviously the inverse is true, right? If we just V-shape this to all-time highs, well, your daily uptrend simply just continues, right? Looking good. Netflix breaking our 575. Finally, guys, after about 2.5 weeks of trading, breaking the 575s to the upside. So this is the best case scenario for Netflix, right? So we had the daily uptrend, then sideways consolidation, daily downtrend, but not a severe daily downtrend. It was literally a weekly bull flag. So such a beautiful weekly move up. Weekly bull flag. A bull flag is just pretty much when you get a severe move and it consolidates sideways slightly down, basically the bull flag, and then breaks out to the top. Why did we have a presumption that this would break bullish? Well, our weekly bulls were in full control. Our monthly bulls, full control of the monthly time frame as well. So usually these daily consolidation periods result, especially when they take back so little of the move, result in a break higher. And now we have the break higher, finally breaking above our 575 area, the top end of the resistance band from 2020 and 2021. So Netflix now looking very good. On to continued weekly uptrends at this point. Your new weekly higher low is set at 550, let's call it pretty much. Any weekly pullback above 550, just looking for a weekly higher low for further trend continuation. Now, what I want to see from Netflix, if possible at all, I want to see continued daily momentum to the upside. And then if we do the breakout retest of this zone, I will probably be making a little bit of plays, guys. If we get that nice little retest of this area right here, that is where I'm looking to make the breakout retest play for a potential swing trade all the way up to the all-time highs. So something like this, retest this area, 583, 576. I know we're kind of almost there right now, but I need to see a healthy retest bounce. And then we're going for the trade to the all-time highs. These stops would go under 550 pretty much from a 580 entry. So about $30 worth of risk. And your reward is pretty much, about $100 to the upside pretty much, right? So very, very good risk reward, about a 3-to-1 trade. Now moving on to NVIDIA. NVIDIA looking very good, but muted price action before their earnings. So earnings next Wednesday, not much in my opinion is going to happen before next Wednesday. So NVIDIA still consolidating at the top. Daily bulls in full control of everything. They set the daily higher low here. Now moving on to higher highs. If ever we lose 696.54, that's okay. Daily uptrend is lost. Daily downtrend will be in motion, but just very healthy weekly consolidation, guys. Weekly uptrend is so massive at this point. Anything pretty much above 475, just looking for a weekly higher low for further trend continuation. So we're going to see what happens on earnings. Can't really advise, well, I'd never advise anything, but I can't really make any determination on how this stock is going to move before earnings. And my expectation is going to stay relatively muted before earnings. And then earnings is going to be your massive reaction to the upside or to the downside. And then we're going to have some plays resulting from that. But NVIDIA, so far so good. Bulls, full control of everything, guys. Control the monthly, control the weekly, control the daily. So not much to be said until the bears prove it to us, until we start getting some hourly downtrends into 4-hour loss of this 12 EMA. Look, they can't even lose this 12 EMA that much since your early January move. So some of these time frames, if they reverse, that will be notable to us. But until that happens, the bulls remain in full control. Now moving on to Tesla. Tesla, 6.22% to the upside, finally setting the daily uptrend. So we were looking, guys, I'll remind you, daily downtrend in motion. Then this last leg was fairly weak. We had a confluence of support zones. We had our downtrending channel line down here at about 175. We had this horizontal support box right here between 180, 175, and we had severely oversold daily conditions leading into those zones. So we were expecting a bounce on Tesla. The bounce happened, engulfed almost 100% of the move. And when that happens, guys, I always say it gives the bulls a good chance to set the daily higher low for daily trend change to the bulls. We finally got it. So daily trend change to the bulls. We're going to be targeting at this point the gap fill from earnings about 207 all the way up to about 210 is going to be the next area we're going to be targeting. On the weekly now, very important on the weekly, how much of this weekly move can the bulls take back to create enough space for the weekly uptrend shift? Similar to exactly what happened here. How much of this move? 100%, right? Well, at this point, guys, we need to see, if you want, in my opinion, the healthy move on Tesla needs to come back at least to about 220, at best 230. Get me to 220 and 230. The bulls have a good chance after that of, when we have consolidation, setting the weekly higher low, changing the weekly trend. But now step one has been achieved. Daily trend change in motion. At this point, any pullback, just going to be looking, let's say we come up into this resistance area over the next few days, just going to be looking when it does pull back, daily higher low, anything above 181, daily higher low to continue this daily trend. I need to see this daily uptrend continue until the weekly hits about 220, 230. Only then will it have taken back enough space to maybe reset this weekly trend as well. I'll remind you guys, Tesla, monthly downtrend, weekly downtrend as well, and now daily uptrend has been recaptured. So your long-term bears are in control of this, but your short-term bulls are now back in motion. So not out of the woods yet, but a good first start from Tesla. And as usual, if for some reason we roll over this entire move because Elon Musk says something or because interest rates go to 20,000% or something like that, well, in any case, I will be buying Tesla, guys. Once again, 180 down to 160, 170-ish is going to be the area that I continue to play Tesla aggressively. Now moving on to Palantir and PayPal. So Palantir breaking above here ever so slightly. So beautiful move on Palantir. Daily higher low is now set at this point. Anything above 23.35. Just going to be looking for a daily higher low for further trend continuation. We are still in this previous trapped equity zone, guys. So pretty much your 25 up to about $28 represents a decent area of resistance where you could have some people from here that have trapped shares that want to sell, and everybody from down here who may want to sell at a 2, 3, 4, 5x profit, right? So just keep in mind, we are in a big area of supply. That being said, Palantir shares are very bullish as of recently. So until the bulls lose that momentum, they are in control of all time frames. Daily uptrend in motion, target is about $28 at this point. Weekly uptrend is gorgeous too. So no problems at all on this new weekly uptrend. If for ever which reason, guys, we consolidate and then lose the daily uptrend into potential weekly consolidation after this like 40, 50% move, I will be targeting some plays on Palantir. $21.50, $22 seems to be like a great location for the breakout into the zone, retest of your previous areas of support back here and resistance right here. Breakout, retest of this zone. I'll be looking to make some plays right down here for potential expansion here into the high $20 range. But bulls in full control of everything, looking good, not much to say. And lastly, PayPal. So PayPal also looking good, continuously staying, trying to stay above our area of support. So I'll remind you, 60 to 57 is a crucial zone, guys. We cannot lose and close below these lows because that would be a loss of the weekly timeframes. Now, the bulls are desperately trying to recapture the daily uptrend, as we were showing yesterday. Need to have a break of Monday's high, 60.55. Get me a break of that, recapture of the daily uptrend. And then we can talk about the higher time frames. But as long as we get out of this area, guys, this is the danger zone. If you lose this to the downside, guys, downside targets become 55, 52, $50 even. But if you remain above this, guys, the structure remains healthy. Your weekly structure as well remains fairly healthy on PayPal, right? So the weekly structure remains as well, cannot have a close below this area. Very important to maintain this weekly uptrend attempt by your bulls. And then thereafter, if we can regain the daily uptrend here on PayPal, we could potentially start mounting above this previous area, which is the downtrending trend line, which is currently sitting, right now at about $63, $64. So we need to get above that. Only, and I'll repeat, only if we start breaking above this and really start negating this trend right here, this whole consistent downtrend weekly and monthly, only if we start reversing this on a consistent basis to the upside, will we start getting more and more momentum and volume coming into the stock and really start pushing us into the maybe high 70s, $80 range. So that remains to be seen for PayPal, but so far so good, defending these weekly levels excessively well. If PayPal continues to, for some reason, sell off, I will be continuously aggressively playing it. 57 down to about $55 is the area that I will be targeting for some short-term trades over the next couple of weeks. So with all that being said, guys, let's get into my portfolio for a quick little recap there. All right, guys, so taking a look at my portfolio, you can see that now we are netly up for year-to-date gains, 7.93% as a matter of fact, outperforming our benchmark indexes. So after having been plagued in the early parts of the year by China-sensitive stocks and interest rate-sensitive plays as well, we have since been able to wheel out of those plays, writing covered calls, getting assigned on those covered calls, so the shares being called away. And now with all this free buying power, we've been able to write aggressively on the put wheel, which has brought us up nicely on the year to date. So 7.93%, that is well above QQQ. QQQ standing at about 7% year to date gains, and SPY currently up about 6.32 year to date. So now we are outperforming our benchmark indexes, and this should just continue to compound over time. Now, before we get into the plays, guys, you'll see that there's a lot of plays. So if you are a fan of the wheel strategy, you may need to re-watch this. I'll be going over them fairly quickly because there's going to be a lot of plays, and I want to keep this a bit short, but I figured I should update you guys now, and then we'll do a final update tomorrow to see where the week stands. But it has been a very good week indeed. So in terms of the positions, guys, don't get overwhelmed. There is a lot. We're going to go through them and you'll see that all of them make a lot of sense. So CSIQ, very, very simply, I just rolled the calls to the 23.5s. I don't know why this says $0 calls, but what we did is we rolled to the 23.5 strike for free pretty much. So our current break-even point remains 25.14. The stock has increased here. We had the 23 calls for about 55 cents for the week, but since the stock has increased, I looked to roll them to next week, and we basically rolled them for free. It didn't cost us anything to roll up from $23 to $23.50. So now we're benefiting from an extra 50 cents increase in share price. If ever this gets overpriced next week as well, we will be potentially looking up to roll to the 24s for as little cost as possible. Try to get as close as possible to our break even here. But if I even get called away, guys, 50 cents, $1 from my break even wouldn't be too big of a deal, since we have managed this position very, very, very well. It has been taking up not a considerable amount of buying power, but still takes up about $10,000, $11,000 worth of buying power here. So just going to be looking to bring this average cost ever so further down. And if we get called away before making break even, that's okay. We've brought our cost basis down so much that the strategy has allowed us to take that small little loss and just move on to a next position. Still love the company, but wouldn't be opposed to be called away and potentially reallocating that capital somewhere else. So now we're going to get into the trades for the week. So we have the cart plays. So now what I want to go over before we get into some of the plays that are currently still active for tomorrow, let's go over some of the ones that we were closing today and yesterday as well. So there is a number of them, guys, and I have the best software in the world to show this to you guys. Notepad. So we took some Datadog 110. So if you remember, there's a lot of these from my Monday's video recap that you'll see. So we had the Datadog 110s. Those have since been closed. So this was an earnings play. We wrote them for about 60 cents. We closed them about 10 cents. I'm going to show you guys all these trades in the order category here. So just so you guys know that I'm being fully transparent with you guys. So we did write the Datadogs all the way back here, if I can find them right. Datadog. too many trades, right? So Datadog, we sold the 110 puts here for about 60 cents, buying them back after earnings for about 10 cents. So pretty much just about over 80% worth of net profit. So very happy about that. That was an earnings play. We also took Shopify 72 puts for their play after earnings, right? All of these earnings plays were significantly below the expected move, which is why I took them. So Shopify wrote them for 33 cents, closed them for 6 cents. Nice, once again, about 80% profit on those. So you can see here the Shopify order for the sell is down here 33 cents, and we closed those pretty much for 6 cents. So that's trade number 2 that we closed. We also had the Coca-Colas 58s for the earnings as well. Wrote those for 26 cents, closed them for 8 cents. Total net profit 18, so roughly about 75% on Coca-Cola. Fairly decent trade as well. So you'll see those down here, 26 cents Coca-Cola. And we closed them pretty much for about 8 cents. So the reason I'm closing these trades early, guys, is to free up the buying power to be able to take another play. So it doesn't serve me any purpose to hold what remains of this contract value until the end of the week. I'd rather take 80-90% profit, take it, put it in my pocket, and take another play potentially to generate even more premium over the remainder of the week. We also took the ARM 108s, which we successfully closed today. So ARM, because of the volatility, presented us a very good amount of premium. Wrote them for 58 cents, closed them for 10 cents today. That trade is right down here. You can see this 58 cents for the ARMs. And we did close them earlier on the day today here, if I can find them real quick. Where is the ARM trade? ARM trade 108 close for about 10 cents right down there. So that was very good. We also took the Airbnb 131s earnings play as well. We got 70 cents for them. We closed them in 1 day for 90% profit here. So very, very good close on Airbnb. So here you see the Airbnbs. Where are they right now? Sorry, guys, there's just too many trades. The 131s filled for 70 cents and then obviously closed for about 7 cents. So another nice little close there. We also took the Instacart 20s. Instacart was trading like $25, $26. So that would have been like a 25% drop. We had a good amount of cushion. We took one put contract for 22 cents, closed it for 2 cents. Very, very juicy trade. So here you can see, right? The first Instacart trade, I have another one for today, sold 22 cents, captured the profit at 2 cents. Very, very good trade there as well. Tesla 182.5, so was able to close those today. So Tesla jumped the gun a little bit early on Tesla, initially on the drop on the week. Wrote them for about 82 cents, closed them for 5 cents today. Very, very good. Over 90% profit. That's exactly what you want to see. Here's a trade right down here. Tesla wrote it for 82 cents earlier on in the week, and then we ended up closing them for about 5 cents today. Very good there as well. PayPal, we had two 57.5 contracts, which we wrote for 46 cents total on the week earlier, and then we were able to close them for 4 cents a piece on the day today. So very good. Used that money and then rolled it into another earnings play that I took today. So 57.5s, 23 cents each. 46 cents total. And then we closed them earlier on the day today here as well for about 4 cents per contract. Very good close there too. And then we had the Baba 71s, traded them at 30 cents, wrote them for 30 cents and closed them about 7 cents. So about 80% profit there as well. And the Baba trade is right down here as well. We took those really early in the week, pretty much on Monday, if I can find them. Those are the 69s. Let me find you the Baba 72s. So here we had the Baba, it should say 71. Don't know why it says 0, but we wrote those for 30 cents here. And we closed them earlier on the day here. If right up here for the $0 puts once again, right? So for 7 cents. So very good. A fair bit amount of trades closed so far. Now, which ones are open? You'll see that the total premium generated this week, guys, across all these trades is over $1,000. So we're really getting back the past 3-4 weeks in a row. We've always been writing at about $1,000 per week. So very, very good management and very good risk as well. None of these plays were truly risky to say. So moving on to the positions we still hold in the account. These will all pretty much expire tomorrow. So we have the Instacart $23 puts for tomorrow. We got 20 cents on each of those. They're trading at 5 cents. So cart should pretty much close above the $23 mark, right? We have a decent amount of cushion until tomorrow. We took those yesterday during the day. We do have about 12% worth of downside. So should be able to close those worthless tomorrow. GDXJs, I'm still in those, guys. We'll see if they close below 33. GDXJ has been trading significantly below that. So we'll see if we get assigned those shares, but wouldn't mind, guys, because those are at extremely good long-term support area. 33, 32, can't be mad. Even if I do get assigned down there, wouldn't be too big of an issue. Now we took the Wendy's. You'll see that this was a very small trade. 2 contracts, the 18s. They had earnings this morning on the day, ending above 18. They should end above 18 on the week as well. So we had a little bit of a wiggle room here on Wednesday on Wendy's before earnings, about 6.5% to the downside. The market expectation was only implied volatility only said about 3% expected move. So twice the expected move to the downside. Decent downside downside cushion, and Wendy's 18 was a juicy level, guys. Look at this beautiful area of support pretty much, and then previous resistance here for the past couple of years. Very happy about that. I know it's not a big position. We only got a total of about $20 on that, but with that $20, I can now go to Wendy's and buy a combo meal or something like that. So then we also had the apples. Apples, we actually opened those today, or yesterday rather, for the $180 strike on this nice little Apple dip that I was telling you guys in yesterday's video that I benefited from the dip yesterday. Wrote the 180s for some decent premium here for about 40 cents for the remainder of the week. There was only 2 trading days left on Apple. So if you want to know how much this play would have ended up for a total week play, just take the amount of days left in the trading week and you divide the total premium by 2. So 0.4 divided by 2 is going to be 0.2 per day. So on a full trading week, this should be 5 days, right? So it should be about $1, and $1 represents our 0.5% rule. 1 divided by 180, that's over 0.5%. So that's why I took the trade. That's how you do a quick mental calculation if the ROI is 0.5%, 1% a week, if it's within your minimums. If you only have 2 or 3 trading days left in the week, just use that quick trip tip, guys. And then we had the Applied Materials AMAT trade, 175s. Applied Materials was only pricing in about a 5% move from their earnings. So from the close, that would have been about roughly, 5% would have put them roughly about 179 with only 1 trading day left. I went with the 175s, got a little bit greedy on those. 175 is the previous breakout area from your previous all-time highs as well, and does represent pretty much the low below all of this week's trading pretty much. So a comfortable level for me. I was pretty sure that they would beat, guys. However, just because of how semiconductors have all been guiding up for 2024, I was expecting a guide up. They obviously supply materials for the semiconductor industry, very integral part of that industry as a whole. Was expecting them to have at least a beat and raise, and that's exactly what happened today. We'll cover them for earnings. And I also have another play that we did on Applied Materials, something that you rarely see me do, but when I have a good feeling about a stock, when the rest of the industry has been guiding upwards for the trends of 2024, I took a 2-week Applied Materials call, the March 1st 210 calls for $1.66. It was very easy for me, and I'll explain why. We wrote about 44 cents of premium at the 175s. So we bought the calls for 166. And we wrote premium for 44. So total net investment, right, is only about $1.22. So $120 for a call on Applied Materials that was a 2 standard deviation play. You remember telling me about those straddle plays that I tend to take 2 standard deviations, calls or puts? Well, in this case, I went with the calls that were 2 standard deviations away, 10% away from the move, and the applied move was 5%. Well, now you can see Applied Materials in the after hours was a very good trade, now at my pretty much strike of those calls. So if we continue momentum into the next week, I have 2 weeks left of time on these. So these should be in the money if this continues into tomorrow's trading. So we might be looking at a multiple, maybe 2, 3, 4, 5x, depending how much this runs into the next coming weeks. Looking forward to taking profit on that position. And now a few last positions, guys. We still have we did COINBASE for earnings. We went with the 132s. 132s was a significant ways away from the share price before their earnings. So 169 down to about 132s pretty much. For 1 day of trading would have been a 22% drop. The expected move was about 14%. So I didn't go full 2 standard deviations, but I did go right in this juicy area of support, the 130 zone, which is where the stock was kind of bottoming out before, right? So I took the risk, and the risk pretty much paid off on COINBASE here for the 132s. Got about 0.5% for 1 day of trading. I'll take that trade anytime. Right, so it was a very good trade there as well. We took the Google 142s today as well on the dip on Google, pretty much sniped the bottom of that one. When it was dipping down here, midpoint of the 142s, I saw an opportunity, was close enough to my 141 bottom. I did expect the bulls to put up some good support in that area, so that's why we took the trade for the Friday close. If I would have been assigned, wouldn't mind. I like Google anywhere around the 140, 142s. I'll play it every single week in the next coming weeks. You guys will see that. Got about 51 cents for 1 day of trading, so that is well above 0.5% a week, guys. 1 trading day remaining, right, on Google. You just do the simple math, right? If 51 times 5 at that point, that would have been $2.55 for the total week, well above our ROI 1% minimum. So that's how you calculate that. And lastly, the trade desk. We took trade desk just to reduce our average cost. We had trade desk shares already have 100 shares that we got assigned around the around the $72 mark right here, we were able to reduce our average cost significantly down to about $63.83. So prior to the earnings expectations was about a 7% move, right? So what I did is I went with the 6250s. 6250s would about twice the expected move, 16% downside cushion for one trading day. I took that trade myself, and now that premium will all be in my pocket tomorrow as well, as the stock is netly trading above. That was almost a 1% trade in one single day on that one. So fairly happy with how that was. And if it would have dropped for some reason and I would have got assigned at 62, that's okay. That would have just allowed us to drop our cost basis a little bit more. And I really like Trade Desk in these lower valuations, despite what I said earlier in the video. $90, not so much a good deal, but down in the 60s, it is a good deal. So that's why I had no hesitation taking that trade. And for the rest here, guys, we pretty much went over everything else. The only other things that I do maintain in the portfolio, your TMF calls that are still active, ETH, Bitcoin still active, TMF shares, 20-year bonds, right, still active as well. Nike, not high enough for covered calls. Trade Desk will be called away tomorrow. This has been a very juicy trade here, guys. Since being assigned on December 29th, right, we've gained pretty much almost 13% of gains on the stock so far by reducing our cost basis. Very, very juicy trade. There's maybe about 7 weeks of trading since we got assigned at this point. So very juicy. That's pretty much, almost 2% a week. Very, very happy with how that trade played out. BABA still writing premium aggressively. I'll continue to write more puts on BABA in the lower $70 range. Continue to bring down our average cost on BABA. Our average cost on BABA now sitting about $78.23 after being assigned at 82. I really like further writing some puts down in the lower $70 range, guys, to just continue reducing this cost basis. And if I get assigned low 70s, high 60s, I really don't mind, guys. I'm trying to pick up as much BABA as possible. And that's pretty much it, guys. I think we covered everything. The rest, the other positions were CSIQ before I got logged out, and my Canadian banking ETF, which just remained stable. So hopefully that was educational for all you guys. A lot of premium. You saw that I did write a lot of earnings plays, but all of the earnings plays that I did write were all conservative, all below the expected move, and a lot of them 2 standard deviations from the expected move. If the expected move is 10%, I was writing 20% below. Always give myself a very wide margin of safety, and the price needs to be somewhere that I don't mind owning the stock. So hopefully that was helpful for all of you guys trying to aggressively write some premium here to recapture a little bit of the drop-off that we had in the account early on in the year. I know I tell you guys all the times to not play earnings, and that is still the case, guys, except, as I said, if you're writing very conservative strikes and you don't mind owning the stock at that strike price, the last thing I want to hear from somebody is, Will, I tried to write some aggressive premium for earnings. I was below the expected move. I got assigned. Now what do I do? If you're not ready to get assigned at that strike price, please just don't take those trades, right? Just because you see me doing it, it's not that easy thereafter to then manage the position. If you're not comfortable with the stock, managing the position, guys, is just going to be a tumultuous experience for you in terms of your emotional and mental control of the position, right? So just always keep that in mind. Hopefully that was helpful. If it was, consider dropping a like and consider subscribing to the channel if you're new. We do these pretty much Monday to Friday. So I hope you guys enjoyed the video. As always, if you have any questions whatsoever on either my trading or any stocks you want me to cover, technical analysis, options trades, something like that, leave it down below in the comments and I'll get back to you as soon as possible. So take care. See you tomorrow for a Friday market recap. Peace.